Hey everyone, can you hear me? Please subscribe to the channel and you can send me chat messages. We're starting in 5 minutes. Just waiting for other people to join. You have to subscribe to YouTube channel to chat within the comments. So I'm monitoring the comments. While we are waiting, what's your name? And which city are you from? We are waiting for other people to join. Hi Ted. Hi Mike. Hi Eric. Hi Fan. Thank you for coming. Yeah, I see other people are joining, and I think we will start in two more minutes. I will give 2 more minutes before I start. Hi, Iconic Rocket from Toronto. As I'm monitoring chat, you can introduce yourself. What's your name? What city are you from? And if you have any challenges with option trading, I might um, obviously give you time later to answer any questions. But what are challenges with option trading? Trading, if you can put in the chat. Hi, Michael. Um, yeah, we have a lot of in-person meetups scheduled in Toronto in June and July. I've not announced them yet, but it's on the meetup website. Hi, Curtis from Calgary. I feel all these online meetups, we get many people from different parts. Hi, Wade. I know Wade. Quang from San Diego. Hi, Quang. Thanks for joining. Okay, so what I'll do is I'll start sharing my screen. Oh, it's too big. No, no. Okay. Hi, Harry. How are you? Joanna, where in Texas are you from? So we will have a recording of this meeting because this is live. I will keep the recording there. And at the end, you will have the at the end you will have the slides for this event also. So I'll share the slide in the chat. For those people who have joined and those who are unable to chat, you have to subscribe to the YouTube channel to get into the chat, and then you can ask questions there. And earlier I used to do it in Google Meet, but this time we are doing it in YouTube live, just because we have a place we can come back to review the slides and review the presentation, and also people can ask questions in the chat. I think it's also better quality. Okay, so I'll start the presentation. First, I'll start with the disclaimer. Hold on, let me remove myself. Okay. So I'll start with the disclaimer. I'm not a licensed financial advisor, and I'm not providing personalized financial advice. And past performance of any stock, ETF, or investment strategy does not guarantee future results. And again, you are solely responsible for your investment choices. And in with options, especially, you can lose your initial amount and more if you're not careful. Um, then there is the option trading disclaimer, especially here. Okay, I'll remove this banner. Okay. So any examples, trade, or strategies shown are for illustrative purposes only and may include hypothetical results, which have limitations. And you should read the options trading options disclaimer and the characteristics and risk of standardized options at theocc.com. Again, it's not financial advice. It's for educational and informational purposes only. Okay, this is our agenda. So we'll start with intro to options, key terms, type of options, buying calls, and buying puts. I'll not be doing any complicated strategy because this is beginners focused. But if you are experienced options trader, what you will really like is the section of implied volatility here and the zero DTE options. Zero DTE options are like crazy. They have the highest volume these days, and convex returns. Convex return concept is a little bit complicated, but everyone should know. So I'll just go through the convex returns concept of the options, and then I will talk about options for hedging, and then options for swing trading, and then how to avoid scams. Now, avoiding scam is really important because if you're new, or even if you're maybe an experienced stock trader, but you're going into the options world and you have come to this YouTube live for options, and like the Facebook and Instagram and Google will hear you, and it'll start showing you options ad. So don't click on this ad. So I'll talk about how to avoid scams and how to actually learn options trading for free or for very little cost, but the thing is, you don't need to buy $2,000 courses of even $1,000 courses, or go into $99 seminars to learn options trading. So option trading is simple, and because of YouTube and Udemy, and they're like low cost resources. So I'll talk about that. So that's the agenda. So let's get in. And if you have any questions, I'll stop by in the middle, and you can look at the chat, and we can ask you can ask questions. Okay, so let's start with the intro to options. Now, so what are options? Options are financial contracts giving the right but not the obligation to buy and sell an asset. Now, this is the kind of like a bookish definition. So what we'll do is we'll dive deep into the actual option chain, and then you'll be able to understand better. So options specify a set strike price and expiration date. So strike price is very important in options, and then the second thing is expiration date. So when you're buying stocks, you don't worry about the strike price or expiration, but with options, you have to worry about strike price and expiration date. And options can be used for speculation, where the returns could be as high as 1,000 to 2,000%. It could be used for hedging. Again, with hedging, the returns could be 1,000 to 2,000%, and we'll see with examples each of these, like how can hedging returns be 1,000% and 2,000%, and that's where the convex return concept comes in. And then we'll talk about like they can also be used for income, but I will not talk about income because this is kind of, I would say, it's still an introductory concept of buying cash secured puts or selling covered calls. But I feel when you're short on options, short on call, short on put, it's still a more complicated concept as compared to just buying calls and puts. Okay, so key terms and definitions, underlying asset. So whenever people say underlying asset, or they are referring to the stock or ETF that you're trading, or the index, and then the strike price is a predetermined price at which asset can be bought or sold. So again, strike price is important, and expiration we talked about. The date at which buy option must be exercised. So that's the official definition or book definition. But expiration date, I think, is if it is too close, means my option is decaying, is melting down. So and you have only until the expiration date to make sure the stock price moves in your direction. If it doesn't move, you lose all your money. So expiration date is very important. Premium is the thing that, let's say if you're buying option, that's your maximum risk, but if you're selling option, that's your maximum gain. So premium is very important. Then the concept of option contract multiplier, and people who are new, they see the value of, like, let's say our option is $8. That doesn't mean you can buy for $8, because you always have to buy for in terms of 100. So instead of $8, you have to pay $800 for that particular option. So when I show you, if an option went from $2, that means I pay $200 and it goes to $4. It means you're getting back $400. So everything, all the option prices should be multiplied by 100. So this is like, again, a beginner concept. And if you are recently joining, we are just discussing all the basic option terms, and then we will go into the zero DT and other strategies. So there are two types of options: call options and then put options. Call option, you buy when you think that the stock price will go up. Put option, you buy when you think that the stock price will go down, to make money. So buying a call option is basically you are anticipating or expecting the rise in stock price, and the main concept here is that the option price you buy, that's your main risk. The premium you pay for the option price, or for the option to buy the option, that's your main risk, and we'll see the example right now. Again, like, if you're learning, and from a book, they might show you this kind of like payoff chart. For example, that the stock price at expiration, and if you and there's certain difference, which is, this is the break even point. So let's say you paid this much amount, maybe $5, you paid, and for it to make money at the expiration, the price should be, let's say, $120. Then you make money, and how much money you make is basically this distance. But let's not worry about the chart. Like, let's go dive deeper into the option chain. So this is a good example. So right now, I think last I checked, Apple is $195.27. So it closed on Friday on $195.27. Now this is the option chain, and your option chain might look different. For example, your option chain, if you're looking using interactive brokers, they might show it in a different way, and we will talk about the interactive brokers. I'll show you the option chain of interactive brokers. But what option chain is, so for stock, we just know, like, Apple is one stock, that's it, right? But for options, we have multiple options to buy, and that's where people can have different strategies. I started trading options in 2007, and my mentor, he was a 70-year-old retired person, and he showed me his spreadsheet, and what he was doing was he was buying based on stochastics and selling options at a 5% or 10% gain. And he was doing consistently, and he was 95% profitable, and he turned $10,000 to $20,000 in 6 months. And this was, I think, 2007, 2008. I have this spreadsheet. So if you contact me, I'll show you his exact strategy, exact spreadsheet. If you just if you message me on Telegram, or I'll share in the Telegram channel. And if you are not in the Telegram channel, I think go to I Don't Trade. That's a new website I'm making, but it's not built. idon'ttrade.com/community. And if someone knows the link, can they send it in the chat for idon'ttrade.com/community? And okay, so there are like different ways that you can buy options, and if you see the shaded part here, those are in the money options, and so left is calls, right is puts, and then the strike price is going down, is increasing. But this is not the this is one way to show the strike prices, but another way might be where the option strike prices are increasing. So you have to be careful. But but based on the without even looking at the which is what is strike prices, I can just tell if the option prices are decreasing, that means we are going out of the money. Out of the money options are cheaper. Out of the money option puts are cheaper, right? So these are out of the money, and we'll discuss in the money and out of the money. But let's look at the option chain. So left is calls and right is puts, and these are the days to expiration. So 5 days we have options expiring, then we have 12 days options expiring, then we have 26 days, and it could go on and on. I guess we go down. I can't capture the whole option chain. So someone is commenting pro trading service, that's why they are called options, because you have a lot of options. Yeah. Good comment. Okay, so let's move on. So buying a put option. So we talked about call option, where you want to buy when where you are thinking that the option price will increase. To buy a put option, you are basically trying to make profit when the stock price will decrease. So a put option price will increase as the basic concept is you buy a put option to make money when the stock goes down. So you are trying to make money when the stock goes down. If it keeps going up, you will lose your premium. So that's the limited risk you are doing. Limited risk is premium paid. And the official definition is that's the right to sell at strike price, but you don't need to worry about it because it's very complicated and no one exercises. I have never exercised any option ever in my life. It's all about exercising, but no one exercises. Everyone closes the position beforehand. And I'll tell you why. Because some brokers might not let you exercise, or even if they let you exercise, they will charge some amount of fee for you to exercise an option. So while you're buying this right to exercise the option to either buy or sell at a certain price, you don't exercise. You just buy it, and then when it is in profit or when it is in loss, you sell it before expiration. So it's very important concept to sell it before expiration. If you're not doing that, then you might lose money paying the fees, or you might get into a position that you do not want. Especially if you're short options, then you get assigned. You don't have the right, you have the obligation, right? So you get assigned if you're short a put or short a call. Okay, so I have the same like how the option profile of a long put option looks. Basically, if the stock price keeps going higher, you have this limited risk, but if it keeps going lower, then you have unlimited return. So you have limited risk and unlimited return. Again, this graph is a little bit complicated, so we'll look again at the option chain. And on the right side, we have the put option. And right now, if the price is 195.27, and let's say in the 5 days, let's say I want to buy this put of 192.50. So what I'm saying is that I'm paying $2.26. This is out of the money because the price is 195 right now. So this is out of the money. And if you buy this 226 192.50 put, and if the option price goes down, then you will make money. But it has to go down within 5 days, and it has to go down more than like a lot more than 192.50 for you to make money. But what happens is right now there are 5 days remaining. But let's say in after 1 day the stock price, the Apple stock drop maybe $1. Even then you can make money. So it's not about like actual price on the expiration date. It's about like how it moves even before the expiration date. So that's an important concept. And again, we can see the puts here. These are the white ones are the out of the money, and the lighter color ones are in the money. So you can make multiple strategies, and if you get an options trading book which has all the strategies, I think there are probably 10 to 20 different strategies that you can do. And also, once you are experienced, you can make your own strategies that are not taught in books. Okay, option states. So we talked about in the money, out of the money. So I just want to define here basically what is the option strike price relative to the current stock price. So in the money, an option that has some intrinsic value. So strike price is below the current stock price, and put strike price is above the current stock price. So that's in the money, and in the money options are considered conservative, and out of the money options, which have no intrinsic value, they are considered more risky. Out of the money options, but out of the money options give you more leverage. So a call, strike price is above the current stock price, or put strike price is below the current stock price. But let's go back and look into the um, option chain, because I think looking at the option chain makes things clear to me. And for calls again, these are the options which are in the money. The why? Because current stock price is 195.27, and if you buy a 190 call, that is in the money because you have this $5 cushion. That's your intrinsic value, and extrinsic value is anything above $5. So 190 call right now is trading at $7 approximately, because it's bid and ask. So let's assume it's trading at $7, and this is the 190 call, and right now the stock price is 195. So there's a $5 cushion, and that's your intrinsic value, and whatever is the remaining value is the time value or extrinsic value. So we'll talk about time value and how it decays later, but I just wanted to introduce the concept of time value. And all the out of the money options which have, for example, 200, right now the stock price is 195, but we are saying we want to buy a call that the Apple price will be above $200, and that is $1.60 in 5 days. And this $1.60 is pure time value or pure extrinsic value. Again, you don't need to understand the actual terms of intrinsic value, extrinsic value, because no one uses it. But it's good to understand that this is the time value, and it is, for example, for $200 call, time value here is lower than $200 call of June 20th. So why is that? Can someone tell me in the chat why is $200 call at 5:30 for June 20th, while a $200 call uh, in 5 days is on March 30th is only $1.60. So my question is, why is the $200 call of June 20th more expensive than May 30th call? And both are out of the money. Both have the same strike price of $200. But why is one more expensive? So if you're just joining, you will have to subscribe to my channel to answer the question in the chat. So Chris says Theta, and Mike says more time. Yes, and Pro Trading Service, they are also saying more time. So it's the more time. So when we have more time, we have more chance of stock to reach that price or go above that price. So more time means more time value, and this is a really important concept that traditional stock traders they don't understand time value, because when we buy stock we have unlimited amount of time, right? We can keep holding and hoping that will go up, but with options you have to be right about the direction and the time if you're buying options. So we talked about option states, and then exercising an option in real life. You can exercise your right to buy or sell at a strike price, but no one exercises it. Maybe only 5% of people are exercising their right. So this is a important concept. So don't worry about exercising. Basically, always close your position before the expiry. This is very important. Always close the position before the expiry. Do not hold it after the expiration. And because sometimes you can be assigned depending on your position, especially if you're doing short options. Okay, so let's talk about theta decay. Now this is a very important concept. So usually whenever I'm buying call option or put option, I always make sure I know about theta decay. For example, let's say I'm buying swing trading. For swing trading, I always buy 60 days or 60 days out. So basically expiration is 60 days, because when you're going from 60 days to 30 days, the theta is decaying, but it's not decaying fast. So we talked about time value. Remember, more time, more more time value, but the it's not linear. So initially it's kind of like linear, but then it drops suddenly the time value as we approach 0 days to expiration. So this is the most rapid, and that's why you have to be careful about. And while so I learned this concept in my master's degree when I was doing in finance, but this concept again is very bookish, and I didn't understand when I saw this chart. I understood the concept, but I didn't feel it. So you have to feel the theta decay, and the only way to feel your theta decay is once you have like actual money on the line. So let's say on Friday, you bought a Google call, and we'll talk about this Google call. On Friday, you bought a Google call, and on Monday, if the stock price hasn't changed, nothing has changed. That option will decrease maybe by 5 to 10%. So why is that? That is because of theta decay. So as and it depends on, like, how far in the time you have bought. So let's say you have bought 1 year expiry. The days to expiry is, let's say, 365 or 300 days. Then 1 day will not make much of difference. But let's say the days to expiry is 15 days. Then it will drop much faster. So you have to be careful about this. And maybe have a like, if you are doing multiple option positions, maybe keep checking every day, or have a kind of like an alert. So Zolon is asking, why is it exponential? Though I don't know why it's exponential. Maybe it's how the options are priced, but when it is less time remaining, it goes like really fast. The time decay happens really fast. But that doesn't mean, I mean, time decay is happening. The only thing you have to be concerned is not holding and hoping for a call option or a put option to move in your direction for a longer time. So I usually buy 60 days out, but let's say if I'm buying 30 days out or maybe 50 days out, it's mostly for quick go in, go out. Maybe you're just there for 1 day or 2 days or 3 days maximum. And we'll talk about zero DT, where you're in and out within half an hour or maybe less. Okay, so risk. Our risk as a call and option buyer, option premium is the most amount of risk, the amount paid upfront that can be lost if the option expires worthless. And then time decay, we talked about time decay. Time decay can happen, especially the value of option melts as the expiration date approaches, especially out of the money options. And that's why people say, oh, buy in the money options because they're more conservative. And some people might say, oh, don't buy our options, only sell options, because selling options make 85% times the money. But I feel you can make money either way: buying the option, selling the option. Selling the option, you make money more percentage of the time, but those percentage of the time where you lose money, you lose big. So it's the opposite of convex returns. So I am more of like, you bet small and you make a lot of money, rather than you bet big and you have the risk to lose a lot of money. So and then there is a volatility concept, and we'll talk about volatility, why option price is sensitive to market volatility. So when the volatility increases, for example, when we were in kind of like 20% recession on April 9th or April 10th, the volatility was really high. And at that time, if you're buying options, let's say if you're buying put options, that's a really bad time, because even if the market moves in your direction slowly and the volatility crushes down, then you will lose money. So we'll talk about like when to buy, like if you want to hedge your portfolio, what is a good time to buy options for hedging. So now let's talk about some real life stuff that you don't read in books or maybe get in courses unless you are trading options. Now this is very important, real life stuff that you should know. Chance of ruin. So whenever you're trading options, don't put all your money in one option, even if you are like 110% certain that this is going to happen. Why? Because you're trying to decrease the chance of ruin. So bet small just to stay alive, and especially if you're new, have a small account, let's say $500 account, and your main purpose is to keep your option account going. Because my first account, $5,000 account in 2007 2008, I was following a particular strategy, and then my emotions took over, and I said, okay, no, this will go up. I don't want to take a loss, like a small loss of 5 to 10%. Then I took a loss of my whole account. So that's why staying alive is really important. So let's say if you're trading options, maybe in the first few months your whole aim is to stay alive, have your account there, otherwise there'll be no account, so there'll be no options trading. Okay. Then the concept of law of large numbers. So we all know that when we flip a coin, it's 50% heads and 50% tails, right? Uh, but let's say right now, or maybe after this, you try it out. Sometimes there'll be more heads than tails. Sometimes there'll be more tails than heads, and it could happen. You have 10 heads or 10 tails. So that's where the law of large numbers comes in. Basically, if you do the coin flip 1,000 times, then you can be sure there will be approximately 50% heads and 50% tails. But if you do it less number of times, let's say you do it only for five number or six times, then there is no guarantee there will be three heads. It could be four heads, five heads, or it could be four tails, five tails. So that's the concept of probability. Basically, why it is important here is that if a strategy works, um, if you think a strategy works, whatever your strategy is, maybe it's fundamental based, maybe it's technical based, whatever your strategy is, you should trade multiple times for it to show an edge. And most people don't do it, and then they try it for 3-4 times, and then they give up on that strategy and go to the next strategy. Okay, so I'm just reading the chat. I'll answer the questions later. How you position size after taking your account from 5K to 50K. So let's say you started with 5K account and you somehow made it 10K or 20K or 50K. Then how do you position size? Like what happens? So let's say when it was 5K, your each position of option was $500 or $1,000 each. But when you took it to 50K, will your position size increase, or what will you do? Will you withdraw the money? So that is really important. Like, when you're option trading, you have to decide, okay, when I make my 5K account to 10K account, will I just compound the position size, or will I take the money out? So some people, they do what is they take the money out, and some people put it in a relatively less risky investments. So that is the choice you have to make. So again, as I talked about earlier, problem is not the edge. Problem is like not having the edge, because everyone has the edge. Everyone knows there are certain ways you can make money. And if you come to my other presentations, we talked about previous day high low. That is a really good strategy. And we talked about, and I have my QE quantum edge strategy. If you see other videos, that is free. So there is edge. The problem is not the edge. The problem is the consistent execution of a strategy to reveal the edge. Again, it comes back to the HSGT thing. You can't just use a strategy for 10 trades and think, oh, it is not working, and or maybe it worked only 40% of the time, and you lost money. So you have to uh, kind of trust the strategy, figure out a strategy, and then stick to it. And if you go to the trading resources page, I have a lot of books which tells you, okay, where is the edge, and I'll share the link in the chat. If you go to the resources page here, okay. So I shared the link in the chat. So click on it and go to the resources page. And there's a section of a book of books where you can look at the books and find your edge. So relative account sizing. So this is again very important concept. When we see on YouTube someone has turned their account from $10,000 to $50,000, that's a high risk account. But it's all about related to your net worth. Like how much is your net worth? So first start small, $500 account if you're new, and then you can just figure out, okay, how to do the option trading, how to place the order, how to place a buy order, how to place a sell order. So start small with $500, and then have once you are experienced, once you know your strategy, have 1% of your net worth. Oh, sorry, that's a typo. Have 1% of your net worth for option trading. So let's say your net worth is, I'm just making it up, 500K. Then you go down to $5,000, and that's your option trading account. size, because worst case scenario you lose this whole 1% of your account, right? So that's the worst case scenario. Same with, again, let's say you have a million network or a 5 million network. So you position size that you position size for that account that way, have 1% of your net worth for option trading. So now this is like a really good rule, because when you're trading options, especially if you're buying and selling, that is the maximum amount you're risking. And that doesn't mean, so let's say you have a 500k network, that doesn't mean you that only means that you are risking $5,000 worth of money. But let's say you have a 50k account and a 500k net worth, then you basically, in your mind, you are saying, okay, this is my 1% of $5,000 account, and this is I will only use for options, and maybe the rest 45k you're using for something else. Okay, so now we will talk about a little bit more advanced concept. So what we did is we covered the intro to options, key terms, and buying call options, put options. Now we'll talk about implied volatility. Now this is like a really the name is kind of like scary for new people, but implied volatility is, think of it as like expected chance of moving of the stock movement, future stock movement. Um, and we'll talk about historical and implied volatility both, and then I'll come to the strategies, zero DT, convex returns, options for hedging and swing trading. Okay, so I think this is a good point. I will take some questions before we jump into the implied volatility. So I'm looking at comments. So Curtis is asking, what platform do you recommend for trading options? So Curtis, it depends on where you are. If you are in Canada, I would say use Moomoo or Interactive Brokers or Questrade, but make sure the commissions are low. And if you're in US, then Robinhood is really good as an introductory platform. But again, their UI is so addictive, it might seem gambling, because we are gambling, but the thing is, we are gambling with an edge. So I would say Schwab is really good. I use Schwab, I use Interactive Brokers. And if you're into algo trading, Alpaca is good and Schwab is good. And again, Interactive Broker is the best one. But again, it's more complicated. So I think start with Schwab. Okay, I'm taking questions here. There's some discussion going on, but yeah, send me your questions. I bought 620 Google call at the money on Friday. Now regretting the decision. Trying to borrow more time if you can. So James, I think we are very similar. I also bought Google call because of the AI news. I bought the Google call from which expires on 627, and I bought it a little bit out of the money, but I knew my risk. Knew my dollar risk. That's your option budget. But if you want to have more time, what you can do is roll over, because you still have that theoretical thing in the mind, and because it is 620, your option will decay faster, right? Because we don't have much time left from now to 620, less than 25 days. So what you can do is sell your Google call of 620 and then buy another call at a later date. So, but again, you have to decide, what risk you're taking, and you should be okay losing all your money in the Google calls if it doesn't happen. Does the seller of the option get all the money the buyer spends? Are the processing charges that go into the processor? Yeah. So seller of the option get all the money besides the commission. So so if I'm selling a call or selling a put at $5, and after commissions I get like $4.95, basically $500, and I get $4.95, which where $5 commission, I keep that money. Okay, any other questions? I'm just looking at the. Okay, no other questions. Okay, so we'll move ahead. And then I'll stop again later on. So we did intro to options. Again, options are very complicated. It's much more complicated than chalk. Then maybe this is live and this is being recorded, so you can come back and see this, or you can just go on Google and search for other videos, or you might buy some books. I have a lot of option books. I have not recommended it, but but I'll recommend some option books, of what I think. But again, you don't need to understand all the option concept before you start trading, because you can start trading in paper account. So interactive brokers give you paper account, Alpaca gives you paper account, and there are like many other brokers give you paper account, so you can just start trading and get the feel of theta, get the feel of implied volatility. Okay, I'll take one more question because we haven't moved. What do you think of long calls, like 2 or 3 year calls? So Sumit, I've used myself, like those are called leaps, and people use it. But make sure you understand the risk, because longer term calls are more risky. Sorry, not more risky. Longer term calls like have high premium, so that's why they have more risk. But again, they don't decay, like in 2-3 months they will still be not decaying. They have less theta decay, so people can hold on to that for a longer time. And of course, longer term calls are less riskier than holding the stock. For example, if if the Apple price is $195 and you want to buy 100 shares, it will cost you $19,500, right? But if you're buying options, maybe in the money or out of the money, I don't know, 2 year out, then it might cost you less amount of money to buy the options as compared to buy the calls as compared to buying the stock outright. Okay, so let's go ahead. We are 45 minutes in. Historical and implied volatility. Let's talk about historical volatility. So historical volatility is very simple concept. Basically, how the prices fluctuated in the past. So, for example, right now, if a stock is doing, like going up and down, or going up only really at a really fast rate, it's trending, or it's like jumping up and down. That if it has fluctuated, that means the historical volatility will be high. So, but historical volatility is different from implied or expected volatility. Historical volatility, think of it as how was the ride yesterday. Is based on actual price movements that have happened in the past. So there's some calculation, but you don't need to worry about it, because we get all these numbers in your brokerage, especially interactive brokers, or History Trade is good one, where you can see all the numbers. In Canada, Mumu is good one, because Mumu is based on top of interactive brokers. So that's why they have all the things in one tab. I don't use Mumu because I'm not in Canada, but I looked at their platform and it's really good. So calculate. So historical volatility. The only concept you have to understand is you are looking at the past prices, and then implied volatility is how much the market expects the stock to move in the future. So even if the stock hasn't moved a lot, and let's say the earnings are coming up, let's say Google earnings are coming up, or Apple earnings are coming up, the historical volatility is less, but implied volatility will be high. So basically, how wild do traders think the ride will be tomorrow or in the future, coming months? And the main difference is historical volatility is calculated based on option prices, or the past option prices. Sorry, the past stock price or ETF price, whatever is the underlying asset. So it's based on those prices of stocks and ETFs. But for implied volatility, they are calculated based on the current actual live option prices. So that's the main difference. Basically, it's kind of like, yeah, you can say it is reflecting the supply and demand of options or market expectations. But that's the main concept. I feel implied volatility is more important than historical volatility. But historical volatility is also important because it gives you an idea of why, when you look at the difference between implied and historical volatility, why there is such a big difference. There must be something. For example, if there is earnings coming up, then the IV will increase, and after the earnings there will be a IV crush. Or before some kind of like big news. So analogy is weather forecast tells you what people think might happen, not what has happened. So implied volatility is future looking, and Implied volatility increases with the panic, uncertainty, or a big event. Like if there is a big speech coming up or big numbers coming up, then the IV because the market is expecting that it will move fast somewhere, like either up or down. And implied volatility decreases right after those events and remain low when there is nothing on the horizon to be worried about. Okay, so let's look at the VIX index. So VIX index is basically the implied volatility of based on S&P 500 options. Now you have to understand implied volatility is is a number for a particular ETF or particular stock. So, for example, VIX index is the implied volatility of S&P 500, but and VIX index is kind of you see it in the news, but the implied volatility of, for example, Apple or Google or some other stock could be very different from the VIX index. So VIX index is general market kind of like fear gauge, and we'll see the chart. So this is the VIX index. Hold on. Okay, so yeah. So this is the VIX index, and this is the daily chart. So if you look at it, it's from 2020, and this was the peak COVID scare on March 18, 2020. And look at the price on the right-hand side here. It hit 85. And then on August 5, 2024, if you remember, that was something happened on that day. The market dropped 5%. I don't know the exact, maybe it was DeepSeek moment. Yeah, I don't know what happened on August 5th, but there was a big drop day. I think maybe it was the DeepSeek news that came around, and then it peaked to 65. And then recently in March 4th, so I think this is a screenshot of March 4th. We'll see the current screenshot. But again, the volatility the VIX index starts increasing, but most of the time it stays within like this 15 to 25 range in most of the time. But then it peaks sometimes. And okay, this is the more recent chart. So basically, what I've done from this chart to this chart, I've just expanded my chart on the daily time frame so we can see. So this was the I think DeepSeek scare, and this was a more of tariff scare. And April 4th was the day when it hit 44, and April 7th was the day when I think it hit 60. And since then it has been going down until recently. It has been down. Basically, the fear has been decreasing in the market. But a good time usually is when the to buy put options is, for example, I did this time when the fear increased initially, it didn't increase that much, and then it comes down. And this is the time, or maybe even this is the time to buy put options, because the fear is increasing, and there's a good chance that it might turn into a bear market. Okay, so let's move ahead. Okay, then there is a concept of IB rank. Now, not all brokers show IB rank. I have seen it in Interactive Brokers. I have seen it in Tasty Trade. I have seen it in Mumu. But not all brokers show the IB rank. But it's a good measure because it measures the current IB related to the 1 year high or low. So if IB rank is greater than 70%, then it's better to sell options and not buy options. But if IB rank is less than 30%, it's better to buy options. But again, this is just rule of thumb. It's not necessary to follow this rule, because if IB rank is 40%, that means or 50%, that means IB is relatively high based on like the IB high and low of the past 1 year. But when IB is high, that means there is a big movement coming up, right? So it's kind of like you should be careful about it, but you should not. You should use it as a rule of thumb. If the IB is high, then that there's a lot of if the IB rank is high, then there's a lot of news that is going to happen is already priced in the price of the options. So many people who sell stocks, they actually look for IB rank which is 70, 80 or 90% high, and because most of the stocks, what they do is they are like slow for a little bit of time, and then they move a lot, and then again they kind of like do not move that much. So IB rank is an important concept, and we'll see. I'm not sure you can see. I tried to put this slide in, but maybe it's too small. But but I think Ivy Rank is somewhere over here. So this is Interactive Brokers platform where I got the number from. And okay, this is 52-week Ivy Rank. So the Ivy Rank is 44. And whenever I look at any of the things, so here are different expiries, and then here is the actual IV. I think it's 106.46%. Again, when I see 106.46%, I feel it is high, but it is. But when you look at IV rank, you look at 44. IV rank is 44 here. That means high was not relatively high. That it has been higher, right? So I would say, oh yeah, you can buy put option, call options, no problem. So again, this is a screenshot from Interactive Brokers. So if you are not an Interactive Brokers customer, you can open up account, I think for free and without any money, and you can open a paper trading account and just look at the how they display the option prices, and with paper trading account you can also trade options. Okay, so we talked about the IV, and IV, I understand IV is like a complicated concept initially, but think of it as like, what's the market expecting? If it is high, that means market is expecting a larger move. So we covered everything into the options. Now let's come to the really good thing, the zero DTE options. Um, Okay, so zero DT. So let's start with zero DT. So these options are basically options that expire every day. They have for each day they have some options, calls and puts expiring every day. But you don't find zero DT on all the stocks and ETFs. There are only particular stocks, for example, SY, SPY, IWM, QQQ, and there are I think 5 or 6 more that have options expiring every day. And they are very very risky. Very very risky means, like, there's a very good chance you will lose all your money. So but some people think that, okay, because it's very risky, we should not trade, and that's a good concept. But for me, it is like, okay, it's very risky, but is it possible to make a lot of money with this? And I and how to control my risk. So it is very risky just because it moves really fast. So when we look at stocks, maybe stocks move 10%, 20%, 40%, or 100% in 1 year, or maybe 200% in 1 year, or maybe 300% in 1 year. But these zero DT, they can move 300% to 1,000% in 1 day, and we'll see the examples. So someone James is saying SPX. Yeah, SPX also has zero DT, and SPX recently had news that the zero DT option have like 50% volume or 40% volume of all options trading volume. So these options are very liquid. They have very tiny beta spread, which is important when you're buying. You can even use market orders, although I don't recommend using market orders to buy or calls and options in general. But with zero DT, and if they are liquid, you can use market orders. So again, it's very very risky, but again, you have a lot of returns possible. So it can move 2x to 10x very fast. So basically, you can have 200% return or 1,000% return very fast. And usually 10 a.m. to noon is my sweet spot. So basically, you start a position and you complete your position within like 20 minutes, 30 minutes. Again, this is more of day trading, but the returns are like huge returns are possible. And if you're doing algo trading, then of course you can automate it, and you can automate it in multiple markets. For example, you can automate it in QQQ and SPY, IWM, all simultaneously with algo trading. And that's why I like algo trading, because your bots or your algos are doing all this day trading without you being involved, and definitely they are much better than humans. Okay, so this is a quick example on May 15th. I will not go deep into previous day high-low strategy, but I have done other presentation and we'll talk about it in another session. But previous day high-low is basically as soon as the market goes up the previous day high. So this green line, dotted green line, is the previous day high, and this is the previous day low. As soon as it crosses the previous day high and previous day low, you just buy. And it was a non-trending day, and this small move going from I can't even see 520 to 521. Okay, yeah, this small move, maybe $1.50 move in QQQ was equivalent to 151% move. So even on a non-trending day, you can have trades which move 50, 100% very quickly. It moved from, I think, from 12 to 1. It was like a one hour holding period, and move really fast. um, so on a non-trending day, you can make 50, 100% returns, and you can lose your whole money, the whole 100%. And when I talk about zero DT, usually people think, oh, it has high theta decay. Yes, it has high theta decay, but in zero DT, Greeks don't matter, theta doesn't matter, delta doesn't matter. It doesn't matter because they keep changing really fast. So you have to be correct about within minutes or within hours of the direction of the movement, and you have to be correct, and you have to be in that right direction. But you have to be correct, and correct quick, and the market will reward you. Okay, now this is a question to everyone. What's the max return can you make? So this is on April 1st, 2025. This is a 477 call option. This is a graph of the option, and you don't usually see graphs of the options unless you are using a good broker. For example, if you're using Shop, their Think of Swing platform has a good graphing of the options. Same with interactive brokers, Think of Swim, which is on Shop, and I don't think Robinhood shows that. Maybe it shows that, but I have not seen. You can use TradingView to see the graph, but on TradingView you can't see the past graphs of options. But this is the one-day graph of zero DT option from April 1st to it's, I think, 5 minutes or 2 minutes graph. Oh, this is a 2-minute candle. This is a 2-minute graph. Now, what is the max return can you make? Can you tell me in chat? So what's the max return you can make in this trade, hypothetically? Let's say you buy at the right price and sell at the right price. So the option started trading on April 1st at 9:30 a.m. and I think this was the starting price, and then it went up, then it went down, and then it went up again, then it went down, and then it went up again, and then it went to almost zero, and then it went to 0.77. Okay, so I think I'm not seeing any answers in the comment, but let's say you bought at 10 cents or 15 cents here. Okay, so this is the price. So let's say you bought at 10 cents or 15 cents here, and then it went up. So potentially it's possible to make 20%. So potentially make, sorry, if you invest $100, it might become um, so. But let's say if you invest $100 here, it can go down, but the max you can lose is your $100. So the max you can lose is the money that you have invested in this zero DT option. So that's where I think the concept of convex returns comes in. That with zero DT options you can make a lot of money, and even if let's say you bought at the last 1 hour, and here it's not zero DT, you could have made like 2x, 3x, or 4x returns. Okay, I'll remove myself. Okay, yeah, here you can make 2x, 3x, or 4x returns. Okay, so now we talked about zero DT. Let's talk about 10 minutes to expiration. And again, it's very, very risky, but for people who are experienced or who understand the law of large numbers, they can use this strategy. They can use this strategy to kind of operationalize and make a lot of money. But the thing is, you have to be very, very careful. But even at the end, for example, at 15:30, it was trading at, let's say, 40 cents, and it went to $2 within like matter of minutes. So put option can move 10x in the last 30 minutes. For example, here it moved from 9 cents to around $1. So James is saying, I have never traded zero DT before. That's why the price per contract was throwing me off. Yes, so the price per contract now, as we talked about earlier, we have this 100x multiplier, if the price is let's say 10 cents, so if the price is 10 cents, basically you multiply it and you're playing only $10. If the price is 10 cents, so that's why you multiply it by everything. And when I say $2, this means like $200. So in 0DT, if you're going out of the money, and if the option prices are in cents or in $1 or $2, then you have to have more contracts to make money. But again, it's very important to manage your risk. Yeah. Yeah, Chris, yeah, you're right. This is lotto, and people call it lotto because it's kind of like lottery. And if you want, you can be on both the sides. Maybe you are instead of buying, you are selling, and maybe you sold at $2 and made money here. So, but again, both selling and selling is also risky, because if the stock price moved against you, then you have kind of unlimited risk. So people who sell options, they usually try to do some kind of spread, so they don't have unlimited risk. They have limited risk. But I think both strategy works. But the only strategy which can have more than 100% return is buying this lotto and selling this lotto. Um, okay, so I'll remove your okay. But again, 0DT is very, very risky. I was just showing you is one of the ways to trade options and to learn options really fast without losing a lot of money. Because for the 0DT options, you can trade with the $100 account, and that's your play account. Okay, so we talked about 0DT options. Now let's talk about convex returns. So convex return is a advanced concept, but I try to make it really simple, and it works with options so well. It works for 0DT, it works for hedging purposes, and I really like convex returns concept. And there's no other tool that will give you convex returns as options. And I'll talk about it, why it is so. So convex return concept is upside gain from a positive event. Positive event means like maybe you're buying a call option, so you want the market to go up, or maybe you're buying a put option, you want the market to go down, right? So the upside gain from a positive event is disproportionately larger, is a lot larger than the downside loss from a negative event. So that's the whole convex return concept. We saw it in 0DT, and we'll see it in options that can be used for hedgings. So upside gain from a positive event is much larger than the downside loss from a negative event. So that's the convex return concept. So let's say you are only buying and selling calls and put options. The losses could be 10%, 20%, 50%, 30%. That's your maximum loss you can have in an option. It's like, maybe you're buying insurance, you're buying put options, right? But option gains could be 20%, 50%, 100%, 200%, 1000%, 2000%. So these are very common returns. If you have a little bit of edge, you can have more than 100% return, and that's how you cover all those 100% losses. So this is the convex return concept, and it also applies to hedging, and we'll talk about hedging. So option for hedging. So now, when I say options for hedging, here we are not buying 0DT or maybe shorter term. Here we are buying longer term options, or maybe like 60 days or 80, 90 days out, or maybe 1 year out. That depends on like how you set up your portfolio of options. But main question is, what are you buying? So let's say you have a portfolio which mimics S&P 500, or you have a lot of money in your 401k in S&P 500. Can you hedge it? Can you make money when the market goes down, so you don't have to, so you are not scared, you're not selling, getting out of the position, because long-term buys, you just keep buying. And how much you're buying, like how much you should buy, that is another question. And on what you're buying, are you buying puts on QQQ, SPY, SMH? We'll see examples of each one of them. I think I use QQQ and SMH a lot, just because if you have a big Nvidia position or big AMD position or big semiconductor position, then instead of hedging using QQQ, you can hedge using SMH, which is the semiconductor ETF. Okay, and how long is expiry are you buying, and when are you buying? So I would suggest buy again 60, 90 days out of expiration, and sometimes I buy maybe over a year expiration. And when are you buying is really important, because as we saw in the VIX chart, we don't want to buy when the market is in panic mode. That's the wrong time to buy. So don't buy when the market is in panic mode. So this is a VIX chart, and again, the right time to buy was not April 7th or April 4th. The right time to buy was somewhere over here, where you're hedging the position. And hedging, I explained it better like that. Like, let's say your house is worth $500,000. You pay $1,000 for insurance in case your house burns down or if there's a flood. You pay that money to the insurance company. You pay that $1,000 premium. Uh, so that premium, you don't expect it to get it back. So similarly, you can hedge your portfolio. Let's say your portfolio is 500K. You can spend $1,000 on put options and hedge it partially, or hedge it like depending on like when you're buying. You can hedge it partially, or you can fully hedge it depending on like how big, where is the strike price, how out of the money you're going. So we'll see a example here, couple of examples. So this is an example of QQQ put at 440 put, and it is showing, it is the June 20 put. It is showing basically it has not expired, but I don't have the I have the chart until March only. But the main thing is, when the QQQ was going fine, it was worth only $2. But as soon as it starts going down, it moved its price to $2 to $12. And then there was kind of like a little bit of relief rally, or like a dead cat bounce, and then it again went down to $5. So you could have bought the option here anytime for hedging, or you can bought the option for here. So this $5 option went to $29, maybe $35, because in the next few days. So this basic option is going from $5. Let's say you're hedging for $500, and it is going to $30, and that is $3,000. So while the market is going down, you are making some money, and you're not panicking, and you're not getting out of the position. So because long-term market will go up, right? But the thing is, right now it's going down. It can go down 10%, 20%, 30%, 40%, as it has done in the past. But while it is going down, you're making some money on the side. So this was QQQ option, and then there is this SMH option. Again, it doesn't show the last few days. I think April 10th it went to $35 to $40. But when SMH was on March 17th or March, you could have bought it in March 7th or March 17th or March 20th, and it was only $5. You buy for $5, you sell for $20, $30. So this is a good way to hedge your positions in Nvidia or AMD, instead of buying puts on Nvidia itself. I mean, that's a good way too. But let's say you have you have a big tech position, or you have a big semiconductor position. These are the options that you can use to hedge. Okay, so let me know. Yeah, you can see this. Okay, so what is a good option to buy for hedging a 100K tech portfolio? So let's say I have a 100K invested in QQQ, and I'm just like a buy and hold investor. I'm a buy and hold investor, and I have a 100K tech portfolio. So what I'm doing is I'm looking at 180 days out, November 21, 2025. I'm looking at this expiry, but you can look at other expiries too. I mean, this is just for example, but I'm looking at 6 months out, and looking at out of the money put options, which is on the right side and it's not shaded. Okay, right side and not shaded. So right now the QQQ stock price is $500, and I feel that okay, it can go down 20%, it can go down 30%, but I'm just hedging for a big recession or a big bear market, right? So I might buy these $400 options or $395 put options, or maybe I might go to $390 and I buy this for $6. $6 is basically $600, and with $600, you're hedging this your 100K tech portfolio with $600, and this is the money that you will lose if it doesn't happen. but that's the way you're protecting your portfolio. And of course, you're not protecting whole of your portfolio, because a calculation like this, if you have 100 shares, because each option controls 100 shares, so basically what you're doing is you are controlling 50,000 worth of QQQ with this $5. So you buy this $5 option, and you are hedged or partially hedged of your 100K tech portfolio. And in case the market goes down, you can sell it and make some extra money, while holding your Q position. So when the market was going down in April, I was selling partially some of my put options that I bought earlier, and making money, but I was losing money too in my long-term portfolio. I was losing more than I was making, but it's better to lose partially than to lose a lot. And the main thing is, you should not panic and sell at a low price, right? So that's why I do hedging with the options, and I think it's a great way. And no other tool, like even futures, they don't let you hedge the same way as options, because when you hedge with futures, uh, let's say you buy a futures hedge of shorting the market on April 10th, that was the bottom, and you buy the futures hedge on April 10th, and you will lose 1:1. So basically, if the market went up 10%, you will lose 10% of your equity in the futures. So it's 1:1. But if I buy, like, even if I'm wrong, and April 10th I buy put option, or April 15th I buy put option, and the market keeps on going up, I will lose only that $500 premium or $1,000 premium that I know. So I know my risk. So that is really important, that you know your risk, and why you're buying it, because the reason you're buying it is for hedging. So you're buying it for this kind of event to happen, and if it doesn't happen, it's good, you don't have to use your insurance. So when you buy house insurance, you're not expecting it to use it, but it is there just in case, and you don't get your money back. So we talked about options for hedging. Now, any questions for hedging, or we talked about convex returns or zero DT? Any other questions that you have, let me know in the chat. And then we'll talk about options for swing trading. Swing trading is basically where you are expecting a movement, like short-term movement, whether it will go up or go down. And I use options for swing trading, so I'll cover that. But any questions? So James is asking question, when you take your hedge off. So I don't usually take my hedge off. I roll over, and of course, when you make money, then you take your hedge off. Think of it like, let's say you have a $1,500 hedge. You have three different options, each of $500. Okay, and when this $1,500 became maybe $7,000 when the market went down. So maybe you can reduce your hedge from $7,000 again to $1,000. So basically, you're kind of like rolling over your position. So maybe, or you sell all those puts of $7,000, and then again buy new puts of $1,000, which is more out of the money. And you know that if the market goes up, it'll become worthless. But if the market keep on going down, you will make money. Okay, any other questions on hedging or zero DTE options? And then we'll go to swing trading, and then how to avoid scams, because there are a lot of scams in this industry. You should be careful about, especially with the zero DTE. Just because they can make good returns, that doesn't mean you need to pay $1,000 or $2,000 to someone. Okay, so I will take more questions, and if you have questions, just ask in the chat. So options for swing trading. So these are the rule of thumb for swing trading stocks, and this is for me, but for you it might be different. But I'm just showing my rules. I usually buy 60 days plus expiry. So basically, right now, let's say if I'm buying in May, for sure it will be more than 30 days, but I try to do 60 days plus expiry. But that's just a rule of thumb, because we saw the, if you remember the chart, the theta decay, it was like this, right? We saw the chart, and we saw the chart. The theta decays really fast in the last 30 days. So that's why I make sure that it is 60 days plus expiry. So expiry should be 60 days more for any swing trading position, because when I'm into swing trading, I am trying to hold maybe uh, for 4 to 10 days or 15 days. So you don't want to this whole period of 10 15 days or 2 weeks near the expiry. So you want it to be far from the expiry. So that's why I do 60 days plus expiry, or maybe 90 days, or maybe 180 days. And make sure, so if you're doing indexes, you have no problem. But if you're doing stocks, make sure they don't have any earnings in the next 30 days. So why is that? Because in if they have an earning, let's say in next week, the price of the call or the put option will have a high implied volatility, high IV. And when it is high IV, you are just paying for the premium that the stock can move up and down. But if you understand that, that you have a kind of like you're betting on earnings, then it is fine. Let's say Nvidia earnings are coming up and you're betting it will go up, and then you buy a call option before the earning. It is high, but you understand that the move could be higher or the same amount. But if you're not playing earnings, then make sure there are no earnings in the next 30 days. And if you're doing some kind of swing trading, if you have some kind of edge using technical analysis, then make sure there are no earnings in the next 30 days. But with indexes, we don't have any that problem, right? So there are no earnings for indexes. Check your option budget. I mean, what's your max risk? So let's say you have $500 risk or $100 risk. So make sure you understand the option budget concept. And this is what I was saying. I think someone we answered one of the questions earlier about. I think someone was talking about Google call. Basically, exit before 20 days or roll over. So let's say you bought the calls for 620 and it is coming up. It is like 25 days left. Maybe in next few days you roll over, you sell that call and you buy another call to extend the expiration. If you have the same bias that it'll go up or it'll keep going down. So you exit before 20 days or roll over, but don't hold it in the last 10 days unless that's your strategy and you know what you're doing. But for swing trading, if I'm holding for 1 week to 2 weeks to 3 weeks, I will make sure I have a lot of time. Okay. Now let's look at the okay. Now let's look at an example. For example, the Google closed at 168 on May 3rd. So again, based on the rules of thumb that we saw here, I'm not looking at 39 days. I'm not looking at 54 days. I'm looking at 82 days expiry. So this is a screenshot from Schwab that you see in the option change. Left is calls, right is put. Okay, so August 15th expiration, which is more than 60 days. That's good. If my budget is $500, maybe I am buying $190 call, which is less than $500. This is $450 and $430. That means this is around. You might buy it at $420 or $425, and that's like $425. It's not $4.15. It's $4.15 times 100. So remember the $100x multiplier, right? And so you can buy this 190 call or you can buy this 185 call. And another thing to note is whether it will be a limit order or market order. And right now the markets are closed, but let's say on Tuesday when the markets are open and you're buying this call, you have to see the bid-ask spread and maybe try to use a limit order to buy this. But if you see penny spreads are like really tight spreads where it is penny spreads are only there on certain ETFs. So if you are doing those penny spread stocks or ETFs, then you don't need to use limit order. You can use market order because the bid-ask spread is really tight. Okay, so for Google, which closed at 168 on May 23rd, I'll buy August 15th, $500 call, and that's my bias that Google will go up. So this is a good example for swing trading. Let's move ahead now. How to avoid scams? So this is very important. Like now we are all learning about options, and if you're new, it is a possibility you will start seeing a lot of ads. So this is the ad like I was seeing yesterday, and if I click on it, I think usually it's like a free seminar, or a link to a sales page where they ask you to pay some amount of money. It could be $9, it could be $99, but usually I would recommend not to buy from Instagram ads. So these are my tips for how to avoid scams. Okay. Don't pay for anything above $200. Now this is a good rule for anything when you're learning. I learned trading by books or Udemy or similar courses. I pay like $10 to $100, but don't pay anything above anything for $200. And this is a good rule of thumb to use. And if someone does really have a secret sauce, or they have a blueprint, or they have a master class, they are not going to tell you for $1,000 or even $10,000. They are not going to give you for $100. So I mean, this is a basic kind of like common sense concept, but when we are new, we try to get into these scams. And this guy is showing how to trade zero DTE options, but if I have a secret sauce, I'll not be telling you about that publicly, right? So no one has a secret sauce or blueprint, so you don't have to pay a lot of money to learn. You can learn on like from traditional books, on Amazon, or Coursera courses, Udemy courses, and everything else. And usually you might see sometimes there is free training in person or online, and 90% of or 99% of the time there is a sales pitch. So you go to these hotels, and you listen to the free training, or maybe you're doing it in a webinar fashion. And if you're paying for those things, if you're paying $99, then it is a sales pitch. You're paying $99 for the sales pitch, and you will be upsold for $999 course or something. So these are my tips to avoid scams. In general, trading has a lot of scams, and option trading has the most scams. So be careful with that. Okay, any questions? And I will send you the link of this slide right now in the chat. So the slides are public, and here's the link I'm sending. So any questions? Yeah, you can put it in the chat. And for I have the resources page at the end. That's my website, irontrade.com. That's work in progress right now. And yesterday I made a podcast. You can listen to the episode of option trading for beginners. I shared this link in the Telegram channel also. And then we have the resources for algo trading, the meetup links, and so each meetup have their own Telegram channel. For example, the Toronto one has its own Telegram channel, and the Austin, Texas based one has another Telegram channel. But usually I post the same things on both the events, except if there is an in-person meetup. Now, one more important thing: if you're joining a Telegram group or channel, how to avoid getting onto scammy groups is basically you set this change in setting on Telegram, privacy and security, go to invites, and make sure it's my contacts, not everybody, because then everyone can invite you. Everyone can invite you in the Telegram channels, other Telegram channels which are spammy. So you have to make sure your Telegram settings are like this. And for people who are new to the Telegram is just like WhatsApp. So, but it's better because when you join when you join these two Telegram groups, you will see all the history of all the resources that have been discussed and posted. And again, no spam, no kind of self promotion in the Telegram groups is allowed. Yeah, these are the resources. Any questions that you have, and you can of course ask questions in the Telegram channel. And this meeting will be recorded. It will be available live to watch again if you want, and you can ask again. I think in the comments you can ask questions. Okay, James is saying again. Just to clarify, James, this is not financial advice. So I think you have to make your own decision. But yeah, if I would be holding those June 20th calls, I will try to exit at a good time and then roll over if I have the same bias. So Harry's saying we swing trade options based on directions and trend only, ignoring all the Greeks. So I think this is a good strategy. It's good to learn Greeks, but Greeks don't work if you're wrong in the direction of the move, unless you're doing more complicated strategies like selling options, selling spreads. So okay, yeah, thanks everyone for attending, and we have these slides. I've shared the link, and you can see the slides. And um, and if you have any questions, you can ask me in Telegram channel, or just message me on Telegram directly too if you have any specific question. But again, this was not financial advice. This is just like I'm showing how I do it. And read the option trading disclaimer at theocc.com before you trade options if you're new. And remember the bid-ask spread. Usually in stocks, the bid-ask spread is could be huge. So make sure you're not using market orders. You're using limit orders. Thank you, Fan. So I will have more of these kind of events, of YouTube live events. And now in this one, we didn't look at particular strategy, but I will share some strategies that I'm using and my algos are using, and what are their returns like, what are their backtesting returns like, and what are their real-time returns like. So we'll discuss these in the future events too. So if you're not part of the meetup, you can go and join one of the meetups so you know where they are. And all the links you will find in idon'ttrade.com /community, and there you'll find all the links of the meetup groups and the meetup channels. Okay, then thank you for coming. I'll close the stream. Bye bye.